All right, joining me is Mike Willis, CEO and co-founder of Hornet ETFs, who's an interesting ETF issuer that currently focuses on combining what they describe as S&P 500 stability with digital asset growth. So they offer the Cyber Hornet S&P 500 and Bitcoin 75-25 Strategy ETF. The ticker symbol is BBB, triple B, and this does exactly what you think. It offers 75% exposure to the S&P 500 and 25% exposure to Bitcoin. And then they actually have three additional ETF filings with the SEC, which these look like they're set to launch in January. And these combine S&P 500 exposure with either Ether, Solana, or XRP exposure in the same 75-25 allocation. It's an interesting approach. And so, Mike, welcome to Crypto Prime.
Nate, thank you for having me. This is going to be good.
All right, so it is very well known on here that I always enjoy a good backstory. And so I thought, let's start with yours, because as I understand it, you've worked in the financial services and investment space for about the past 30 years or so, right? You've been at places like UBS, Payne Weber, Smith and Barney. So I'd love to have you tell us more about that. And then I'm very curious to hear how that led you to co-founding Cyber Hornet ETFs.
Sure. I traded my way through grad school. I was getting my MBA in finance at Cal Poly San Luis Obispo in California, and trading always fascinated me. I wanted to beat Wall Street. I back in the day, I started trading in 93, 94, and during a time when they didn't have the internet didn't have real-time data feeds, so I would satellite dish it in, with software. It was about a $50,000 deal before everything was said and done back then. Now you can get it for $9 a month. So it's always been a passion of mine. I saw Wall Street as free markets, capitalism, a way the little guy can participate in a big company, not have to be able to buy Apple computer, but they could own the stock for a couple $100. Seems like a good deal. You participate as a small owner with a big firm that you have your eyes on and want to be a part of. So I've always loved the concept of Wall Street, how the little guy can get rich, being smart. And so I set out to beat Wall Street and started trading in the mornings and then going to school in the afternoons for my graduate degree.
And so then talk about how all of that led you to Cyber Hornet ETFs.
Sure. So I initially went to work for Smith Barney, was trained on Wall Street, and always considered myself on the buy side, not the sell side. And what that means in the broker land is the sell side really is the front-facing brokers that pitch stocks to and mutual funds and such to their clients, do the asset allocation and all that. The buy side is more the portfolio management, and because I had done I'd taken $10,000 student loan and grown it to $500K trading initially. And so I had done a ton of trading. When I went to work for Smith Barney, I remember interviewing for the job, and he said, well, do you have any, the manager said, do you have any sales experience? And I went like, no. I didn't know why he was asking me that. And then I was like, am I at Smith Barney? And so then he said, well, we'd like to see at least something, even it can be car sales, it can be anything. And I go, nope. But I can show you my portfolio trades. And I pulled out 2 years of trades, and his eyes just kind of glazed over, because they're not looking for that. They're looking for salesmen that will pitch the stocks that the buy side analysts at the firms recommend. So really the brokers are front facing salesmen, and they are repeating or passing along the recommendations of the firm for the most part. So that was kind of an eye-opener, but initially went to work for Smith Barney. Then Payne Weber, was Senior Vice President of Investments at UBS. Before I created my own registered investment advisor, and then registered investment company, which is a mutual fund company. And really, after about 20 years, realized how difficult it was to beat the S&P 500. The methodology I was using, we were in front of the S&P for 7 years in a row. Felt pretty good. And then in 2013, the S&P buried us. It was up about 32% that year. We were up around 14 to 16% for our clients. And Warren Buffett also was reporting that year at Omaha, his Berkshire Hathaway annual shareholder meeting. And all of us who watched, all of us PMs who pay attention to that kind of thing, we knew that Berkshire Hathaway was kind of at a precipice, because Buffett would always say, if I can't beat the S&P 500, fire me. And he had a rolling 5-year number that was in jeopardy due to this massive outperformance by the S&P. So we were all kind of wondering. And so he came on, nothing was said about it. And normally that's when they tell you how they did against the S&P. And he didn't say a thing. And I looked at the annual report, and it said down in fine print, they still showed that they beat it. And I was, wait, how did they do that? And then I looked, and they changed it to a rolling 6-year. So to get the number to work for him. But and after that, I don't think Buffett did that. I really think it was all the marketing folk and attorneys that did that. Because after that, Buffett really went on a bully pulpit for the S&P 500. He has a standing bet for $1 million against any hedge fund manager over a 10-year period. He's never lost. And at the same time, we said, you know what? The market is shifting to index funds. People no longer want to pay a percent to a financial advisor. The performance just isn't there. So we shifted over to index funds, and we went out and got the index ticker symbol. Couldn't believe it hadn't been taken yet. So we've been managing that for over 10 years now. And so that's the 100. We already had the relationships established with the S&P 500. Then became Bitcoiners about 7 years ago. So that changed everything, because, we now have, I spent my whole life studying money, and I could go really deep for you, but essentially what excited me about Bitcoin was, it's freedom money. It's an even playing field. It's peer-to-peer. It's bankless, trustless, permissionless. It's all the things. It has a set monetary policy. It's governed by code. It's not at the whim of the Federal Reserve, whoever they are. So it was, it would definitely changed everything. So as we looked at the landscape, we wanted just to junk TradFi and go right into DeFi and sink our teeth there. But I realized that, I had something not very many people had, and that was a 30-year background in TradFi, and I was a Bitcoiner at the same time. So we took a look at the market and said, how could we add some value to it? And so we stayed in the space, and our goal now is to bridge TradFi to DeFi, and really, about $3 trillion has come into crypto out of the 100 trillion or so on Wall Street. So there's still, the vast majority of Wall Street is sitting there. So how can we move them into the digital space? We're still early, and we have some great ideas on how we're going to do that.
In terms of bridging TradFi and DeFi, when I think about the specific investment approach with your 75-25 stock crypto allocation, we can talk more about that here in a moment in more detail. But from a broader competitive positioning standpoint, is Cyber Hornet intending to always offer crypto exposure in ETFs, or could you envision broadening out beyond crypto-related ETFs? You gave a good backstory there, where there was this convergence of you coming around on indexing and index-based approach with the S&P 500, then obviously the crypto light bulb going off. So is it always going to be a marriage of those two, or are there broader goals with Cyber Hornet ETFs?
Yeah, crypto will always be involved in our products going forward. So, 5 years ago, Michael Saylor coined the term Cyber Hornet. It's the pinned tweet on his X account, has been for 5 years. and that mascot has, stuck to the Bitcoin community. And so we chose Cyber Hornet ETFs is the name of our firm because we are, we're Bitcoiners. And beyond that, we do see the value of the whole decentralized financial superstructure that's being built. Even beyond Bitcoin, for a while we were Bitcoin maximalists, and we still lean toward that. But we will offer the other largest cap crypto products because financial advisors need a full body plan, and they have clients coming to them in these different spaces. And one of our goals is to offer a full digital asset plan for financial advisors. We think they represent the third wave to come into Bitcoin. They're gatekeepers of $30 trillion. They don't understand Bitcoin. They don't understand crypto, but they're going to have to because their clients are bypassing them.
Okay, so you currently have one ETF on the market, as I noted. Again, that's the Cyber Hornet S&P 500 and Bitcoin 75/25 Strategy ETF, ticker BBB. Do you want to walk through the basic mechanics of this? I think it's pretty straightforward, but I'll let you describe it.
Sure. We actually own all 500 of the underlying S&P 500 companies. That gets rebalanced on a quarterly basis. Currently, we are managing the Bitcoin exposure with Bitcoin futures in our BBB product. However, that is going to be moving over to spot first quarter of next year, along with all the new ETFs. We're rolling out actually 4 in that we have filings for, Nate, with the SEC. You can go online and look, but it's triple E for Ethereum, triple S for Solana, triple X for XRP, and triple Z is for the crypto top 10. And so we do a 25% weighting in the crypto exposure. We rebalance monthly, and the strategy's there for. We wanted to pick a percentage that would make a difference if crypto really does what we think it's going to do. We don't think a 5 or 10% weighting is enough. We also think if you go up to 50% allocation in an ETF, you now have taken the volatility past what a lot of people can handle. In my professional experience over 30 years, if I'm down 40% for a client, they're burning up my phones. If I'm down 50, they're out. If I'm down 60, it's a potential lawsuit. So advisors have to be aware of this, and so they are. And so when you look at the back model numbers going backwards, we tried to find a sweet spot that would take the big hits that Bitcoin normally takes and try to keep it in the 30% range, because we knew if you get up to 40%, you're going to lose most of the people. So 2 years ago, when Bitcoin was down 64%, the next year it was up huge, over 100%. But most people didn't experience that because they got shaken out when it was down 64%. No, there's not a lot of people that can handle a down 64% year. People think they can. And I know the hodlers and Bitcoiners are different. They can, but they're not buying the ETFs. They own Bitcoin in cold storage, more than likely. And that's, and they're hardcore Bitcoiners. So they're not buying Bitcoin through ETFs. The people buying Bitcoin through ETFs are a different scope of people, and they need a little bit more hand holding on those big dips.
But in terms of the overall allocation, you were alluding to this. The rule of thumb that you'll typically hear put out there is, say, a 1 to 5% allocation of Bitcoin. Clearly, you're advocating for something greater than that. I guess talk more about that and just the overall investment thesis here.
Yeah, we think, and it can be used different ways for different people. For the average retail investor, we like it because, we're going after the Bitcoin curious and Bitcoin hesitant at this point, because wave number 1, we identify as the unregulated phase, the first 16 years of Bitcoin, where you had to fight to get it. You had to go to an unregulated exchange. You had to figure out a digital wallet. You had to figure out public-private keys, cold storage, no 800 number to call when you sent it to the wrong person. all the things. Those are the pioneers. Those are the, the guys that not only did they not care that the exchanges they bought Bitcoin on weren't regulated, they were in the F the Fed category. So they did not want the SEC involved. So that's wave number one. About $1 trillion came in over those 16 years. Then wave number two started last January 10th when the SEC allowed Bitcoin to be available on regulated exchanges in ETF products, and you could, for the first time, buy it in your own brokerage account. These people that wave number two that came into Bitcoin and crypto, they were already sold on it. They were just not willing to go into an unregulated exchange situation and risk an FTX scenario. So they all swarmed in, as we would say at the Cyber Hornets, and they broke all records for a new asset class introduced by an ETF, and way ahead of gold, and basically did what gold took 20 years to do in 1 year. So the demand is definitely there on Wall Street for Bitcoin and crypto. So the third wave that we are identifying is the financial advisors, the 320,000 FAs and family offices and RIAs across the country. And they have not started recommending Bitcoin or crypto yet. And so they're gatekeepers of 30 trillion in assets. We will call them the Bitcoin hesitant. And then there's the Bitcoin curious, two segments of the 90 plus trillion dollars still on Wall Street not to invest in the crypto side of things. And really, we're using the S&P 500, the grand champion of TradFi, the most well-known index name on Wall Street, to smooth the volatility of Bitcoin and help bridge these Bitcoin hesitant and Bitcoin curious investors over into DeFi, the DeFi space, give them a smoother ride and a more familiar and we think a safer way to play the space.
Obviously, you've seen all of the historical data on Bitcoin. I'm curious, you're well aware of the narrative that Bitcoin is quote unquote digital gold, but there is a lot of debate out there around whether Bitcoin is a risk on asset or something that is lower correlated or uncorrelated to the broader markets. And so my guess is there may be some people that look at this and go, if you're combining Bitcoin and S&P 500 exposure, it's too risk on exposures. How would you respond to that?
Yeah, we love it because traditional, let's face it, Fidelity and BlackRock are going to scoop up all the pure crypto plays. In our opinion, it's a race to zero for fees on those structures, and only the biggest ETF companies are going to be able to handle that. So what's left is the smart or alpha plays in the crypto space, and what kind of crypto strategies what can you do for investors that's a little more unique than just holding the pure play. And so most people handle the volatility when you try to offset vol, you pick a non-vol category like treasuries, or you may even short the underlying asset. And so that's traditionally where Wall Street would go. And nobody's going to protect vol with vol. But because the S&P 500 is basically boring to a Bitcoiner, millennials don't even look at SPY. They go straight to the Qs, QQQ. That's one of the reasons we targeted the triple ticker symbol tickers, and we feel very fortunate to get them because, frankly, all the best tickers are gone and have been snapped up. But that's how we are uniquely positioned in the space. We think compared to Bitcoin, S&P is low vol. We understand though that Wall Street considers the S&P vol, and so we are using vol with vol. But in the end, we're going after a demographic that wants a higher risk return exposure. And really, we're also targeting the $3 trillion sitting in five S&P 500 index funds, because all those people know the brand so well that we're giving them their favorite index, but we're giving it to them with a crypto kicker, and we think that's going to be attractive to a few of them.
In terms of the actual holdings in this ETF, you mentioned that currently this holds Bitcoin futures, but you noted that you're going to transition to direct spot Bitcoin access. But on the S&P 500 exposure, you also noted that you're obtaining that by holding individual stocks. I'm just curious, what do you see as the benefit of doing that versus, say, just holding an S&P 500 ETF?
Yeah, it's a big difference to be a fund of funds as opposed to an asset manager. So anybody can do a fund of fund structure, and it's basically a fee on fee structure. So you have the ETF cost, then you have the underlying fund cost. And you can't expect an FA to come in with his fee on your fee on another fee. That's triple feed. So a fund of fund structure, I don't think, is taken seriously outside of target funds and annuities and some other places. But if you want to position yourself as an asset manager with unique IP and native tech, you separate yourself by getting in there in the weeds and doing everything. In addition, we want to be more open to democratizing Wall Street in terms of their voting their shares. As you know, you can buy Tesla stock and you have access to the annual shareholder meetings to vote your shares. But if you buy Tesla stock through an S&P 500 index fund, well, then BlackRock, State Street, or Vanguard are voting your shares. So we, part of our positioning is that we're not BlackRock, we're not institutional, we're founder run. And so would you rather have BlackRock voting your shares or us? And then we also want to give you the ability to vote your shares. So we have some unique offerings there. And you can't do that unless you own the underlying 500 securities.
Okay, and that makes sense. And let's just assume we set aside the individual securities themselves. I guarantee you there are going to be at least a few people out there who will ask you, why can't I just buy, an ETF, an S&P 500 ETF at 75%, right? Buy BlackRock or Fidelity's Bitcoin ETF at 25% and be done with it. Don't pay a management fee. How would you respond to that?
Yeah, it's not just a little number. We think it's about 25 to 30% will ask that question. And, there's a lot of do-it-yourselfers out there. They won't only ask the question, they'll go out and do it. The bottom line, though, is there's another 75% that don't want to sit there and try to rebalance 12 times a year. If you think of FAs with 100 accounts, having to rebalance those accounts 12 times a year, if you forget, that could put you in a situation where it was way over balanced in one direction or the other, out of balance. So, and then also part of this is that to smooth the ride, the product's got to be in one package, and I'll explain. If you even if a broker says, you know what, I'm going to save the fees, I'm going to do it myself, so he puts IBIT over here and SPY over here, the client is still going to see the allocation to IBIT. He's going to see that Bitcoin just dropped 40% in 3 weeks. And the broker's going to take the call. Clients call when their positions are up or down 20% a week. And brokers don't like that. And the clients get antsy. They want to talk to their brokers. And it's one of the reasons brokers don't like putting their clients in vol products. So by bearing it inside a 75% weighting in the S&P 500, for example, last year, BBB did 39% when the S&P 500 did 25. So you got a 14% bump over just holding the S&P 500. Conversely, year to date, we're up 10% and IBIT is down 5%. So there's a 15% spread between us and IBIT So we're giving you a smoother ride. Whereas if we just held the individual stock or the individual ETF of Bitcoin, you're still going to see and feel the pain of that ride. And, as a trader, you go up against fear and greed. And as easy as it sounds to hodl, it's not. And when it's going down, I'll tell clients ahead of time, hey, not even clients, because we don't do that anymore. We just do the funds. But I'll have friends and they'll say, hey, how should I buy Bitcoin, or what should I? And I go, well, are you okay with it being down 50%? Yeah. The minute they go in, they're calling me like 2 weeks later and say, hey, it's off 5%. I'm already down, and it's like, well, wait, didn't we just talk about this? So clients think they can handle the volatility. We don't think they can. So part of the reason we do what we do is because we believe in the long-term returns of Bitcoin and the decentralized DeFi space. So we want our clients, our shareholders, to get that long-term return. And the way we think they can get there is by not going through the wild swings that really wear you out. And so that's our concept. And yes, there'll be people that do it themselves. We're going to target the other 75% or so that don't.
If we move beyond BBB, we mentioned that you have these filings with the SEC for 3 additional ETFs. Again, these would offer S&P 500 exposure combined with either Ether, Solana, or XRP exposure. Now, those are set to launch in January. Is that correct?
They are on track for that. Obviously, subject to SEC approval, so we can't really comment on launch dates. But they were going to have an effective date in December, if not for the government delay. So now they're slated for January, but we can't comment on dates because that's up to the SEC. But there is a 4th one. It's not just the 3. We are doing triple Z's as well, and that's also slated for January.
And the underlying exposure for that will be?
It'll be 75% S&P 500, 25% crypto top 10.
Okay. So let me ask you this. Do you view the investment case, let's put aside the index-based exposure. If we just take Solana, XRP, and Ether, do you view the investment case for those differently than with Bitcoin? Because again, I think the general narrative is that Bitcoin is digital gold. I would say Ether and Solana are viewed much more as technology plays. I think XRP just generates a lot of debate on both sides. So how do you view the case for these crypto assets outside of Bitcoin, just at a high level?
Yeah, I do think they all touch a different space. Bitcoin is the gold standard. It's the currency, the digital currency that has emerged as the leader. I see Ethereum as the leading DeFi platform protocol. I see Solana as the hot NFT slash ICO space, token launches, etc. And then I see XRP, is replacing the Swift banking system. All have their own little niches, and as do the rest of those cryptocurrencies, in the top 10 or 20. And really, that's our focus, is just in the top 10 or 20. We understand digital asset people jump in because they're trying to get the next Bitcoin and get it before it's 100,000. But we do think Bitcoin's in a different category from all the rest. So we will offer a market cap weighting when we give exposure to like the crypto top 10, because we do think that Bitcoin deserves the heavier weighting as the market, dictates. So as the other assets grow, if Bitcoin doesn't keep its Bitcoin dominance, then obviously we'll adjust, just like with the S&P 500. And you have a natural, inside the S&P 500, you have a natural turning of technologies. AI and semiconductors definitely took off in the last couple of years within the S&P 500. And we'll keep an eye on what happens in the top 10 in the crypto space. But we're committed to giving our shareholders both in a very smart, disciplined way.
just a couple of minutes left here. So to that last point, if you're focused, say, on the top 10 or top 20 crypto assets, let's say these initial ETFs that you're rolling out, hopefully in the first part of next year, and we add triple B to that, let's assume these all have some success. It sounds like you could envision launching additional crypto-related ETFs, correct?
Yeah, certainly. I think we're at the tip of the spear here, and we're still early. And I'll explain. Just a week ago, the SEC issued a no action letter on the DTCC, allowing them to tokenize all stocks. That's just mind blowing. Then, about the same time, you had Bank of America come out and say their clients could now purchase Bitcoin and hold Bitcoin through them, and then didn't stop there, but went one step further and said we believe a 1 to 4% allocation for our clients should be considered. And I think that really puts the pressure on brokers to figure out what this is. And but the fact that we're so early and we're seeing things, Coinbase announcing that they're going to start trading stocks. Things are changing so quickly here, and this administration is so pro crypto. And with Gensler out, and you have a pro treasury, pro commerce, pro crypto SEC. We see, and then the CFTC getting involved now. I think you're going to see an explosion of opportunity here. So as we really drill down on this, and we just brought on a new CTO, and working on 2 apps that we're going to take to the public, and there's some really cool things we can do now that we couldn't do before. And we really believe the top 3 products we have right now are not going to, 3 years from now, probably going to be quite a bit different, because the opportunities are just exploding in the space. And so I think, we're definitely leaving the door open for whatever.
Well, I'm certainly interested to watch as your story unfolds here. You probably saw the stat. I think there's something like 125 or 130 crypto-related ETF filings currently with the SEC. So to your point on an explosion, we're going to see a lot of product, a lot of innovation here around crypto. But I certainly wish you the best of luck moving forward. Thank you for joining me, Mike.
Thank you, Nate. It's a privilege being here. Have a good holiday.
Thank you. That was Mike Willis, CEO and co-founder of Hornet ETFs. Hope you enjoyed this episode of Crypto Prime. As always, you can stay up to date on all of my latest guests by visiting CryptoPrimePodcast.com. Thank you for joining me.
Crypto Prime is hosted by Nate Geraci, president of OTR Media LLC. Nate is also president of investment advisory firm Nova Diaz Wealth Management. While OTR Media and Nova Diaz are related by common ownership, they are separate and distinct entities, and anything discussed on this program should not be construed as an official statement by Nova Diaz. Some guests appearing on this program may also be financial sponsors of Crypto Prime. This program is for informational purposes only and does not constitute investment advice. Investing in crypto assets involves substantial risk, including the possible loss of principal. Any past performance figures discussed are not necessarily indicative of future results. Visit CryptoPrimePodcast.com for more information.